Are you ready to start investing but worried you might make costly mistakes? What if I told you that most beginners lose thousands of dollars not because the market is unpredictable, but because of simple errors that could have been avoided? Today, we're going to break down the 5 most common investing mistakes beginners make, and how you can avoid them to grow your wealth safely and smartly. Mistake number 1. Not having a clear plan. Investing without a plan is like setting out on a road trip without a map. You might end up somewhere, but it probably won't be where you intended. Many beginners jump into stocks, real estate, or crypto just because they heard it's profitable, without considering their financial goals, risk tolerance, or time horizon. A solid investing plan starts with 3 questions. First, what is your goal? Are you investing for a house, retirement, or building passive income? Each goal has a different timeline and risk profile. Short-term goals, like buying a house in 3 years, require safer, more liquid investments, while long-term goals, like retirement in 30 years, can handle more volatility. Second, how much risk can you tolerate? Risk is not just a number. It's about how comfortable you are with your investments fluctuating in value. If you panic and sell every time the market dips, high-risk investments aren't for you. Understanding your personal risk tolerance will guide your asset allocation, helping you choose between stocks, bonds, or alternative assets. Third, how much can you invest regularly? The key to building wealth over time isn't getting rich quickly, it's consistency. Decide on an amount you can contribute monthly without hurting your lifestyle. Even a modest $100 per month, if invested wisely, grows significantly thanks to compound interest. By answering these questions, you create a roadmap that keeps you on track. Without a plan, you risk chasing trends and making impulsive decisions that can erode your capital. Mistake number 2, letting emotions drive decisions. Markets are unpredictable, and beginners often let fear or greed dictate their actions. When prices drop, panic sets in, causing many to sell at a loss. Conversely, when prices soar, fear of missing out, or FOMO, pushes people to buy at the peak. Successful investors don't eliminate emotions, they manage them. Here's how. First, stick to your plan. If you know your investment is sound for the long term, short-term volatility shouldn't sway you. Remember, temporary market dips are normal and even expected. Second, use dollar-cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when prices are high. This strategy reduces the risk of mistimed decisions and smooths out market fluctuations. Third, review your portfolio periodically, not daily. Constantly checking stock prices or crypto values only fuels emotional reactions. Set a schedule quarterly or semi-annually to assess performance and rebalance if necessary. Mistake number 3, focusing too much on short-term gains. One of the biggest traps beginners fall into is thinking investing is a way to make quick money. Headlines promise rapid returns, but real wealth building is a marathon, not a sprint. Chasing quick wins often leads to high-risk bets, speculation, and stress. Instead, adopt a long-term mindset. The stock market, on average, has returned about 10% annually over the last century. But this average is achieved by holding investments through ups and downs, not by buying the hot stock of the month. Consider this. If you had invested $1,000 in the S&P 500 in 1980 and reinvested dividends, by 2020, it would have grown to over $15,000. That's a 15x increase. Not from chasing trends, but from patience and letting your money compound over decades. To stay long-term focused, set measurable goals. Track your progress over months and years, and avoid reacting to daily news cycles. Mistake number 4, ignoring diversification. Diversification is often called the only free lunch in investing for good reason. Putting all your money into a single stock, sector, or asset type is risky. If that one investment tanks, your portfolio suffers. Beginners sometimes ignore this principle, thinking they can pick a winner, but even experts get it wrong. Diversification spreads risk across different asset classes, sectors, and geographic regions. You don't need dozens of investments, but you do need a mix that balances growth and stability. A simple approach. Start with a combination of stocks and bonds. Stocks provide growth, while bonds provide stability. For example, a 70-30 split 70% in a broad stock index fund and 30% in bonds gives exposure to growth while cushioning volatility. Add international exposure. U.S. markets aren't the only opportunities. Global diversification protects against localized downturns and opens doors to growth in other regions. Consider alternative assets cautiously. Real estate, REITs, and commodities can enhance diversification, but they also come with unique risks. Educate yourself before adding them to your portfolio. Mistake number 5. Neglecting education and research. Many beginners jump into investing with little knowledge, relying on tips from friends, social media, or even influencers. The problem is that these sources often don't understand your personal financial situation and may give advice suited for short-term speculation, not long-term growth. Investing is a skill that improves over time. Start by learning the basics. Understand financial statements, market cycles, and key investment principles like compound interest and risk-reward ratios. Study the history of markets. Knowing how markets behave during recessions, bull runs, and crises gives perspective and reduces emotional reactions. Use credible resources. Books, courses, podcasts, and reputable websites are far more reliable than random social media posts. Over time, your knowledge will allow you to make informed, confident decisions. Also, track your own investments. Keep a journal of why you bought or sold each asset. Review successes and mistakes. This self-reflection accelerates learning far more than theory alone. By avoiding these 5 mistakes: investing without a plan, letting emotions drive decisions, chasing short-term gains, ignoring diversification, neglecting education, you dramatically increase your chances of success. Now that you understand the mistakes to avoid, let's turn these lessons into practical steps you can apply today. First, create your investing blueprint. Start by defining your financial goals clearly. Write down short-term goals like saving for an emergency fund or a vacation, and long-term goals like buying a house or funding retirement. Assign timelines and required amounts to each goal. This will guide not only where to invest, but also how aggressively you should invest. Next, determine your risk tolerance. A simple way is to ask yourself, if my investment drops 20% tomorrow, would I panic or stay calm? Your answer helps define your portfolio mix. Conservative investors lean toward bonds and index funds, while aggressive investors can tolerate higher stock allocations. Remember, risk isn't inherently bad, it's simply a tool that must align with your goals. Then, decide on a consistent investment amount. Automatic transfers to an investment account each month take the guesswork out and reduce emotional decision-making. Even small contributions, when compounded over years, can grow into significant wealth. For example, investing just $200 a month with an average 8% annual return over 20 years grows to over $110,000. That's the power of consistency. Managing emotions is next. One of the most effective strategies is to implement a cooling-off period. Before making any investment decision, wait 24 to 48 hours. This prevents impulsive reactions driven by fear or excitement. Also, avoid checking your portfolio daily. Constant monitoring reinforces emotional reactions. Instead, schedule quarterly reviews. During these reviews, check if your investments align with your goals and rebalance if needed. Rebalancing involves adjusting your portfolio to maintain your target asset allocation. For instance, if stocks outperform and now make up 80% of your portfolio instead of 70%, selling some stocks and buying bonds restores balance. Let's talk about the long-term mindset. Understand that markets fluctuate and short-term losses are normal. Think of investing as planting a tree. You don't see instant growth, but with care and patience, it will eventually bear fruit. Avoid trying to time the market, because even professional investors struggle to predict short-term movements consistently. Diversification is another critical step. Start simple. Invest in broad index funds covering multiple sectors. For example, an S&P 500 index fund gives exposure to hundreds of U.S. companies. Pair it with a bond fund for stability. International funds can further diversify risk, and small allocations to real estate or commodities can enhance long-term returns. A practical tip: don't overcomplicate. Beginners often think they need dozens of individual stocks. Instead, focus on a few diversified funds that cover multiple sectors and regions. This reduces risk and makes management easier. Education and research are your best defense against mistakes. Dedicate at least 30 minutes a day to learning about investing. Read books like The Intelligent Investor or Common Sense on mutual funds. Follow credible financial news and use investment simulators to practice without risking money. Track your own decisions. Keep a simple journal: what you bought, why you bought it, and how it performed. Over time, you'll notice patterns, recognize mistakes, and improve your strategy. Personal experience, combined with theory, accelerates your growth as an investor. Remember, investing is not a gamble. It's a skill you can learn. Avoid these mistakes, stay disciplined, and watch your wealth grow steadily over time. If you found this guide helpful, make sure to hit the subscribe button now and turn on notifications. That way, you won't miss future videos packed with strategies to help you invest smarter and grow your wealth faster. Investing is a journey, but with the right knowledge and mindset, it's a journey that can lead to financial freedom. Start applying these lessons today, and you'll be miles ahead of most beginners who dive in blindly. Your future self will thank you.